But first, we're going to start with stocks striking back 6 months after the bull market high. Stocks are making a comeback, a continuing comeback, grinding back the levels since bottoming out on that December 24th and 26th of last year. The S&P is now within less than 4% of its all-time highs. So 2 questions tonight. Is it safe to buy now, or have you already missed it? And what can you do to maybe catch on to this rally? The train left the station, Guy, but is it the Acela? Is it going to Washington? You're only in Delaware or Baltimore?
That's a great question.
And we're glad Joe pulled into our station tonight, by the way.
Nice. He does.
That's
not written. That's not written anywhere. That's not written anywhere.
That was good stuff.
What do you think, though, guys? Seriously.
Tim with the early brown nose. I think that's fantastic.
I learned that at the
can't get brown.
The Acela's going from Penn Station in New York to Washington, D.C. You're asking me where the train is right now.
Yes.
I happen to think the train is in Baltimore. A lot of people still think it's in the tunnel out of Grand Central Station. That's what makes markets. And, Joe, I will tell you, for the last 200 S&P points, I thought we were going to roll over and retest those lows. So, I think we're a little long in the tooth. With that said, I think there are some trades that make sense. I think healthcare has worked, and I think energy continues to work. But if you're asking me to make a trade that's sort of what's going to catch up, like what's been lagging and what's going to finally catch up, ask me that question, Joe.
What's going to finally catch up?
And what's been lagging?
That's a great question.
And can you get away from the train metaphors as well?
Well, I didn't bring us into the train metaphor, okay? I just tried to add on to the train metaphor. I think I did a nice job, by the way, for the East Coast fans.
Right.
But what can catch up? I think AT&T. Now, that has been a lagger since the beginning of 2017 when it was $42.50. But if you look, recently made a low of about 28.5 on monster volume. Seems to have reversed. Seems to finally have gotten their act together. Yes, they probably overpaid for a couple acquisitions. And yes, everybody from now Time Warner seems to be gone. But maybe they're so far ahead of the game that it's starting to pay dividends now. They got into the DirecTV deal a few years ago. I think that's going to start to pay dividends.
Well, I know no one likes to hear this, but what happens if the game is wrong and that the catch-up trades are not the place to go? And if you feel that the market's coming to an end, then the ones that have worked are actually going to come off.
But AT&T, Steve, look, so I'm long AT&T. But my question to you guys, what's the catalyst now? Because ultimately, we've had an opportunity to deliberate deal, no deal on Time Warner. We've had an opportunity to deliberate, they have too much debt on their balance sheet? Are we in a high debt environment? Are rates actually squeezing? You tell me what the catalyst is.
Here's the catalyst. Great question. And, Joe, you're still the host of the show. Remember that. So anytime you want to jump in.
I'm tired. I already did 3 hours.
I think interest rates are going to continue to go lower, and people are going to say, you know what, if rates are not going higher, 10-year yield around 2.6, probably headed lower than that, maybe these high dividend players start to make sense on top of the fundamentals that might be fun.
Can I just talk overall for a second? So we're up 20% from the December lows right now. The notion is that the best levels of the year could already be in, number one. You've talked about, and I've kind of yanked your chain about this. Yeah. You've talked about decelerating earnings and valuations holding back the market. Well, it hasn't held it back at this point. Are we at a terminus here?
See, the problem is that if you feel like we were due for a sell-off, which we have felt on this side, some have felt on that side, that we're due for a sell-off and it's overdone, when do you jump in and say, okay, that's it? It's the last straw, the nails in the coffin. I think you have to wait until Q1 earnings have decelerated, went negative, and see what the guidance is. I've waited this long. So I've missed it. I missed this last 10%. I thought there was going to be a 10% rally. I missed the last 10.
What would you buy if you got
UNH.
5? Would you buy? No, not what. If you got 5, if you got a 5 pullback, are you going to be able to pull the trigger?
So I do stay long stocks. I believe in momentum and timing. So I still am long equities. So if you get that 5% pullback, I think if you ultimately believe that we're going to make new highs, you don't go for the ones that have lagged for the wrong reasons or the right reasons. You go for the large cap tech.
So you're talking about the theme of this is the catch-up trade, and you're trying to give me
I think you have it. So the reason why I would play the catch-up trade, I would go healthcare and I would go UNH, and it's a theme that you are very well versed in. There's been political headwinds with UNH. It's been Medicare for all. It's been prescription drugs. It's been drug rebates. I think a lot of that is noise, and UNH will figure its way around that ultimately. ultimately, that's a catch-up trade that I'm willing to buy.
But I mean, to me, that seems, I get it as a catch-up trade, but it seems like there's just so many headwinds that are still out there. So in the healthcare sector, I'm not sure I want to be there if it's a catch-up trade. Why not just go with what's been working for the last 10 years? You have a Federal Reserve that's going to keep rates low, at least on the long end, or at least on the short end. I'm not so sure about the long end. So why not just go with the names that have worked? You know, go with something like energy. That's worked really well. Why not go even down the chain on energy, like to rig, Transocean, one of those type of things for the offshore, seeing if oil's going to go higher. The materials, they actually don't look so bad at this point in time. I think the playbook is we have a Fed who's going to keep rates low at 2 years and under. What works on that?
Well, the two places, Joe, that I would say are catch-up trades are trades that I would argue have been catching up since really the fourth quarter and had underperformed much of last year. So that's, first of all, emerging markets. And if you look at the EEM or the VWO or however you want to play this at home, you can see that we're essentially back up, third time up against resistance, somewhere around 43.50 on EEM. It really does look like in an environment where the dollar today touched down at the 50-day again, does not look like it has any gas unless the Fed gives us a different message on Wednesday, which I don't think they will. I think the dollar is range bound. That's very good for the rest of the world. So talk about catch-up trades. You know, we spent much of 2018 saying, how about, you know, how can the U.S. outperform the rest of the world?
But is your premise built on the dollar, or is it about growth?
Well, it's first of all, growth is priced to zero. So my concept is I think the delta on expectations is enough that actually people are going to reassess just how bad things are or not so much in the rest of the world. You've got stimulus coming out of the Chinese central bank. You've got stimulus or at least lack of any tightening coming out of Europe. If you look at the charts, actually the outperformance of the EEM versus the SPY is about 8.5%. I agree with Brian also. You know, this is a reflationary environment, even though rates don't tell you that. Rates are being held down by policy. Energy is still the most shorted sector out there. XLE, I like Halliburton.
The problem is, I hear you, there's just there's zero growth. To your point, there's zero growth, but I don't think the market has digested zero growth.
See, I thought we've had this argument, and I thought so too, right? And that's why I was bearish. I was bearish up until last week because I thought the market was going to reprice weak earnings. But what happened was the bond market priced it in. The bond market priced in the potential for a cut by the Federal Reserve. And in that environment, if the equity market is looking at that as a positive, I have to reverse my bearish call and say, you know what, I was wrong about that.
The equity market right now is factoring in zero raises and maybe even a cut and quantitative tightening ending. So we're not.
I don't think either one of you guys gave enough credence to how gut-wrenching the move to December 24th was. It got just about, and we're going to have Julian on in a second, but every analyst that was at 3,000 as a price target for 2018 were suddenly at 2,750 on the S&P for a price target.
I'm not going to speak for Guy, but I will in the theme of this.
20%'s not good enough to shake out the complacency. Why has it got to retest?
But at that point, it doesn't have to retest.
Well, for a while you've been saying that.
But once Powell changed stance and became ultra dovish and started talking about quantitative tightening ending,
just in
then
technical, just sentiment-wise, we waited for the pullback, and we got a nasty pullback. And then when you had 20%, you didn't like it. You didn't want it.
26th and said we were going to rally 10%. Did you not watch it on Christmas vacation?
Wait a minute. On the way to
that's where I was.
On sentiment, though, I think the point is positioning got so extreme. So first of all, we have really had a once in really a market event, effectively the V that we saw here, and it comes down to positioning. I would argue if you look at AAII, bull bear spreads, whatever, we're actually in an environment where positioning is reaccelerated to where bulls have the upper hand.
It would be much better if you bought with both hands at 2,300 and didn't say any of that. Let's get to Julie.